On May 15th, Jerome Powell's term comes to an end. Last week, he walked out of his final press conference, put his glasses in his pocket, and quietly stepped away from the most powerful financial position in America. Most Americans do not realize that the Federal Reserve is not the government. It operates as an independent institution, specifically designed to be insulated from the daily crosshairs of politics. Its entire job comes down to one task: controlling interest rates. That is the baseline price for borrowing money in the United States. This diagram illustrates the direct cascade effect on the consumer. When the Fed pulls that lever down, borrowing gets cheap. Mortgages drop, car loans become affordable, and the housing market heats up. But push it up, and all of that debt immediately gets more expensive. Because that single metric dictates the monthly budget of almost every household in the country, it represents an immense concentration of power. And right now, politicians are aggressively trying to control it. Donald Trump has spent years attacking Powell's tenure. During his first term, he went so far as to publicly label the Fed chairman an enemy of the United States. That political pressure recently escalated into a legal offensive. The Department of Justice launched a criminal investigation into Powell, targeting a budget overrun during a renovation of the Fed's Washington headquarters. Powell aggressively pushed back. He argued the investigation was entirely manufactured, a legal weapon designed specifically to coerce him into dropping interest rates. A federal judge eventually agreed with Powell and threw out the DOJ's subpoenas, halting the immediate legal threat. He survived the barrage, but with his term ending in May, the institutional firewall protecting the central bank is about to be tested by an entirely new leadership team. To understand why the White House wants cheap money so badly, we have to look past the political insults and look at the underlying math. Lowering rates creates an immediate, highly visible economic high. Mortgages get cheaper, people spend more, and stock prices jump. That is a highly desirable environment for an administration heading into a midterm election cycle. This bar chart shows a much larger systemic issue at play. The United States government is currently holding roughly $36 trillion in national debt. Looking at the chart, we see the penalty for carrying those obligations. When interest rates stay elevated, the government pays more to borrow money. Dropping the rate saves the Treasury hundreds of billions of dollars a year in interest payments. The intense pressure to slash rates is largely a push to bail out the government's own massive balance sheet, rather than an effort to help the average consumer. The Federal Reserve, however, is legally mandated to ignore those political incentives and look strictly at the macroeconomic data. This graph tracks our current inflationary reality. Core inflation is stubbornly holding at a 3.2% baseline. Add in the ongoing war in Iran, and you get a sudden, sharp spike in gas and energy prices. If we project what happens when cheaper borrowing is introduced into this exact environment, the line shows a steep upward trajectory. The consensus among economists is that cutting rates right now would act as gasoline on an inflationary fire. By law, a sitting president cannot legally remove a Fed chair over this kind of policy disagreement. They can only fire Federal Reserve officials for cause, meaning a legitimate legal or ethical violation. This is why the Department of Justice went after a building renovation budget. It was a weaponized attempt to manufacture that legal cause, bypass the fire mall, and force an override of economic reality. At his final press conference last week, Powell held the line. He left rates unchanged between 3.5 and 3.75%, citing extreme unpredictability in the global markets. Now, a new nominee named Kevin Warsh is waiting for Senate confirmation. Warsh is widely viewed as being more open to cutting rates, though it remains completely unclear if he will bend to political demands once he actually sits in the chair. We have very clear historical data on exactly what happens when a central bank bows to the demands of the White House. In the 1970s, sustained political pressure kept interest rates artificially low to juice the economy. The result was a devastating runaway inflation rate that peaked at 14%. The historical precedent proves that when elected officials are allowed to dictate the price of money, it consistently destroys the purchasing power of the working class. Which brings us to the immediate question waiting on the desk of the incoming chairman. Will the next wave of financial decisions be dictated by the objective data of the economy or by the political demands coming from Pennsylvania Avenue? The preservation of the Federal Reserve's independence acts as the ultimate guarantor of your purchasing power, directly dictating what you pay for your house, your car, and your debt every single month.